The Australian dollar has been relatively range-bound this week, supported by a better tone to global equities, but with its gains capped by a disappointing rise in Australia's unemployment rate. The Japanese yen has become somewhat more stable, though it remains a concern for global markets and for Japanese policymakers near term. US equities, of course, have improved somewhat with support from oil prices. The rebound in the oil price has been led by the expectations that there might be something coming out of OPEC and Russia in terms of freezing production at January levels. There's obviously considerable skepticism about this, but for the time being, it's been enough to provide some support for oil prices and therefore for US equities and indirectly the Australian dollar. So US equity markets are looking a little bit better, but the US dollar continues to be hampered by market skepticism over the outlook for the Federal Reserve's monetary tightening. We saw upside surprises on January retail sales and industrial production this week. This supports Westpac's view that better data is on the way for the US economy and that markets are being too pessimistic. However, market pricing for one Federal Reserve rate hike is not 100% until December 2017. Until markets become more serious about the chances of Fed tightening in 2016, we expect the US dollar to be somewhat mixed and a little bit weak overall. So a somewhat softer US dollar tone is one of the factors supporting the Aussie at the moment. Commodity prices too are lending some background support. The gold price continues to skew higher, while iron ore hit $47 this week, its highest level since November. That's also about $5 above what the government assumed in its December mid-year economic review. However, we do have our doubts about the sustainability of the iron ore price rally. Supply from Australia continues to be very robust, but we suspect that supply from Brazil has been interrupted by the Samarco disaster, and therefore later in the year that supply should pick up again. Westpac expects the iron ore price to fall back to about $40 by June. The Australian dollar had a setback on Thursday when we saw Australia's January labour force data. The fall of 8,000 in total employment wasn't too shocking, but it was certainly disappointing to see a return to the 6% unemployment rate last seen in September. Job creation in the fourth quarter last year was clearly very strong, and there are risks that it decelerates further over Q1. This is a potential concern for the Reserve Bank of Australia because its statement on monetary policy projected ongoing falls in the unemployment rate. Westpac, meanwhile, expects unemployment to drift up towards about 6.2% by June and hold there through about September. This does increase the risks that the RBA will cut rates at some point this year. Markets are pricing that in, but Westpac continues to expect a steady hand. The international calendar in the week ahead looks fairly low-key, with no obvious event risk for the Australian dollar. Domestically, the calendar will be quiet until Wednesday, when we see readings on Australia's wages growth on Wednesday and also construction data. Then on Thursday, it'll be the key capital expenditure survey of business investment in the fourth quarter and for the year ahead. That will be a key ingredient for the fourth quarter GDP due in early March. With the Aussie dollar, the global mood is probably positive enough for it to make a test at, say, 72.50. However, we do think the risks multi-week are still to the downside for the Aussie, given that we expect the US dollar to regain its footing and also that iron ore prices are likely to resume their downtrend. That should see the Aussie dollar back to, say, 70, 71 multi-week. We'll speak to you next week.